I recently saw a post on the value investing subreddit where someone is complaining about value investing. And I'm sure you know how Reddit works. If you go on Reddit, in a subreddit, and you're going to complain about the thing it should be about, everyone is going to come against you. But that person, he or she is somewhat right in what they wrote. He or she, let's assume it's a he wrote that the way to make money in the stock market is to hold cash and then wait for the dip in large cap stocks in household names and then invest in those companies. According to him, that's how his semi-literate neighbor has been making money. And then he goes on to give a list of those companies, for example, Meta, Spotify, Tesla, Amazon. These companies, according to him, if you invested in them when there was a dip, you would have made money. But this is not what value investors will tell you to do on this subreddit and also on YouTube everywhere else. They will tell you that you have to look for obscure companies that nobody ever heard of, companies in Rwanda, in Papua New Guinea. Invest in those companies at 2 times earnings and then wait for others to come and invest. That's how you make money. But most value investors lose money this way. That's why I believe that we should analyze really what this person wrote, because he's somewhat right and also somewhat wrong. Why is he right? Because I can give you examples of myself or people I know that made money on large cap stocks. For example, Meta in 2022, the stock was trading at $90, $100 a share. And today it is trading at over $500 a share. It's in 2 years. If you had invested in Meta, that would have been one of the best investments ever. And Meta is one of the largest companies in the world. You don't really need to go deep and do research on Meta. The information is readily available for everyone. There are hundreds of analysts following these companies. There are thousands of people making videos on Meta. If you want the news on Meta, it is readily available. And by the way, this is today's video sponsor, City Falcon, which I use every day to look at the news of the companies I'm following. I like to differentiate the news and the noise. And City Falcon, through its numerous filters, allow me to do that. It allows me to filter the news for specific companies, for companies I'm following, for my portfolio. If you're interested, you can use the promo code Ishfaaq for 25% off any subscription. Let's go back talking about Meta or even Apple in 2016. The company was trading at, I believe, 8 times earnings. This was a no-brainer investing in Apple. It is a market leader. We can say the same thing about Meta, a market leader, company with a moat, company with good fundamentals, growing at a rapid rate, although Apple not growing that fast anymore, buying back shares, paying dividends, require little capital to grow. Why not invest in such a company? Warren Buffett invested in Apple in 2016. I invested in Apple and both of us made lots of money on Apple. What it all comes down to ultimately is to invest in a company that you understand very well. And most of the time, these are going to be the big companies, not the small, obscure ones. What you're looking for is to minimize your risk, to minimize your work, and increase the potential reward. That's what many people don't understand about investing. They think that they are going to increase the risk and increase the reward. This is the wrong way of thinking. You want to minimize the risk. Take only the necessary risk. Don't take extra risk that is not necessary. You take the necessary risk and then you maximize the reward. That's why you invest in companies, let's say, that have a good balance sheet with a net cash position. You know that cash is safe. You invest in this company, the company can pay you a dividends, can return the cash to you through buybacks. This is safe. But over the long term, holding cash is not a good idea because of inflation. So you are actually increasing the risk holding cash. So you want to minimize the risk. And investing in large companies, household names, sometimes with all the information that is available, you're minimizing the risk. And also you're doing less work. That's how you allow your money to work for you. Since many people already did the research, you don't have to go deep and do the research yourself. Of course, you have to think about what other people wrote, what other people are talking about. But this information is readily available. So you minimize risk and work and increase the potential reward. But what that person gets wrong is the list that they gave. I don't believe that Amazon, Spotify, or Tesla are good companies that since I've been investing in the stock market, I would have invested in such companies. I never thought of them as being undervalued. Only one I can agree on this list right now is Lululemon, which I have in my portfolio. But I'm not buying Lululemon anymore because I have better investment opportunities. It is undervalued, but the margin of safety, it's not really here. It doesn't happen that often for you to have a large cap household name to be undervalued, really undervalued, for you to make an investment. So I get the idea of that person wanting to hold cash, at least in the short term, and then when they have the big opportunity, they are going to buy it. But it's rare. It's not that common. That's why people who have the time, they're going to go deep and look for really those obscure companies. There's nothing wrong looking for a company in Rwanda or Papua New Guinea. But if you have the time to make the research and understand this country, this market, I'm not even sure you can invest in such countries. But if you have the time, do the research, invest, please. But most people don't have the time. So yes, in The Intelligent Investor, Benjamin Graham talks about this, investing in large cap companies. Nothing wrong with that. And for most people, this is what I will advise. But it's not this list. Still rare to find these good opportunities. You don't want to just invest and fall into the trap of investing in a company like Microsoft in 2000. At the peak, I think the PE ratio was 100, and then it started falling. If the PE ratio is 50, it is still overvalued. Even though the stock price is down 50%, doesn't mean it can go down further. The stock price of Microsoft went down further, and you had to wait 16 years to break even on your investment if you had invested in 2000. Although in these 16 years, the fundamentals of Microsoft were improving, the earnings, the revenues, everything was growing. What happened was that the market was not ready to pay 100 times earnings on Microsoft anymore. This is what happens. So that's why you don't want to overpay for quality. Ultimately, it all comes down to how much time you have to dedicate to investing and building a good portfolio. You don't need 100 companies in your portfolio. 5 or 10 companies usually is enough. As I have in my portfolio, I would recommend you watch this video next. Have a nice day and goodbye.